Caterpillar is being called out as a top pick for 2023 by the team over at Cowen. Let's go inside the call with Cowen analyst Matt Elkott. Matt, good to see you here. Make your case on Caterpillar, because I think some would argue this is a contrarian call to make a play on an industrial machinery company if we are going into a global recession.
Yes, Brian. It may be. Actually, this is the second time we pick it as our top pick. We had it as our top pick for 2022, and it's for 2023 as well. It is a cyclical company, and it would appear to be a contrarian call when you're looking into a recession. But I think this cycle has many nuances to it. First of all, you have the infrastructure bill. The narrative coming from the machinery companies over the last few quarters has been that projects related to infrastructure, the infrastructure bill would start hitting the backlog late in 2022 and into 2023. The last concrete data point we got on this was from Deere, which has an irregular fiscal year and reported in late November. And they've actually started to see that. We're looking at the shipments of sand, crushed stone and gravel on rail, which we identified back when we initiated last year as having a 0.9 correlation with CAT's North American construction industries business. That's been the highest performing car loading group on rail, up about 12% versus rail traffic being down 1%. That's been like a consistent story for the last year or so. So those are, the infrastructure dynamic is not really a cyclical dynamic. It's just it's an anomalous event that will continue to benefit CAT for and Deere and many of the other construction equipment companies for the next few years. And then the other thing is what I like to call the global state of energy insecurity post the Europe conflict, where now we're scrambling to get our hands on any type of energy we can get, whether it's conventional or new power technologies. And that's going to be a big tailwind for CAT's mining segment and oil and gas segment, but primarily the mining segment, because we've had false starts to the mining equipment replacement cycle for about 10 years or so now, because the miners have been under pressure by shareholders to do share repurchases instead of spending money on projects. So I think that's going to take off finally. So you're right, it's a cyclical industry in a slowing economy, but there are many dynamics that are unique to this cycle, which will extend it to 2024.
Matt, that started to get into what my question was on the global front, because if we were to see a slowdown as some of the other countries around the world perhaps enter into a recession prior to the U.S., what is that exposure that Caterpillar has if those countries do start to pull back on those construction projects that they had either earmarked funds for or just holding off on beginning?
Yeah, no, that's another great question, Brad. I mean, it's all another nuanced picture, because you're probably going to have certain regions of the world pulling back and becoming more tempered, like Europe, and then you're going to have at the same time regions like China hopefully starting to rebound. Remember, China was the first to do lockdowns back in late 2019, early 2020, and when they did reopen the economy, they had basically one of the biggest ramp ups in their history as far as manufacturing. We're not expecting anything like that now as they ease COVID restrictions, but you could see China start to improve in 2023 and into 2024 as Europe, tempers a little bit. India is probably going to continue to be solid because there is an infrastructure bill there. There's a lot of infrastructure spending. So I think on the balance, when we look at the rest of the world, it might be net neutral for CAT in 2023. But I think the North American picture is going to be more positive.
Matt, one risk that you call out that I don't hear a lot of your peers calling it out, at least when it pertains to Caterpillar and other companies like it, is someone on the street view it as an unfavorable play on sustainability. Walk us through that.
Yes, they have pretty sizable exposure to the mining sector. They sell equipment to the oil and gas sector, so I think those are the two main things. So Before the state of energy insecurity we entered after the Europe conflict, people viewed a good portion of their business as being in secular decline. When I did my analysis when I launched last year, I put that percentage at 28%, because you can't really punish them for the part of coal that's metallurgical. You need that to, if you're going to have any type of growing in a global industrial economy, you need metallurgical coal, even for EV growth. So thermal coal will be in secular decline, but I think 28% was the percentage that I came up with as having less than favorable, ESG attributes. I think some people's calculations probably included a slightly higher number, maybe as much as 1/3 of the business or just slightly more. But I feel like investors now are more willing to exercise patience in this new world we're in.
You mentioned John Deere earlier. Is what you're believing to be true for Cat not true for John Deere?
It is true for John Deere, Brad, but their exposure to the construction industry is lower than it's sizable, but it's lower than Cat's. John Deere has been really a precision ag story for years now. It's a theme that a lot of investors are very bullish on, rightly so. It's it's a very promising area. I've been a little bit more cautious on the Deere stock than I really needed to be. We have it at market perform, but the stock has really done very well over the past year or so. But I don't think the prospects of 2024 being another growth year for Deere are as strong as they are for Cat, because they don't have the mining exposure, they don't have the oil and gas exposure, and they have a smaller exposure to infrastructure.
Matt, before I let you go, you also highlight a 10-year, $30 billion sales opportunity for Caterpillar from autonomous various operations or ventures they may be going into. What does that look like for Caterpillar? More machines that don't require a driver?
Yeah, more machines that don't require drivers, mostly initially in closed environments like mining. They already have autonomous trucks there that improve efficiency and productivity. Actually, this is a very timely question, Brian, because I think just yesterday or the day before, they announced the first autonomous partnership with an aggregates company, a crushed stone and sand and gravel company. So they're introducing autonomy into that market as well. I think, what's next is probably, longer term is road building and construction, introducing autonomy in a kind of phased out manner. It can be a closed environment, but it's more open than mining or aggregates. So, there are opportunities across their many businesses to grow revenue there.
Cowen Transportation OEMs analyst Matt Elkott. Matt, really fascinating stuff there. Thanks for breaking this down for us.